Hello and welcome to this video on interest rates, a concept that helps us understand how much it costs to borrow or lend money. In this video, we will learn what interest rates are, how they are determined, and why they matter. Interest rates are the percentage of the principal amount that a lender charges a borrower for the use of money. The principal amount is the original sum of money that is borrowed or lent. For example, if you borrow $1,000 from a bank at an interest rate of 5% per year, you will have to pay back $1,050 after 1 year. The extra $50 is the interest that you pay to the bank for using its money. Interest rates can vary depending on various factors, such as the type, term, and risk of the loan or deposit, the supply and demand for money in the market, and the monetary policy of the central bank. The type of loan or deposit refers to whether it is secured or unsecured, fixed or variable, simple or compound, etc. The term of the loan or deposit refers to how long it lasts, such as short-term or long-term. The risk of the loan or deposit refers to how likely it is that the borrower will default or the lender will fail. Generally, higher interest rates are charged for unsecured, variable, compound, long-term, and risky loans or deposits. The supply and demand for money in the market depend on various factors, such as income, inflation, expectations, preferences, etc. When there is more demand for money than supply, interest rates tend to rise. When there is more supply of money than demand, interest rates tend to fall. The monetary policy of the central bank refers to how it controls the money supply and interest rates in the economy. The central bank can use various tools, such as open market operations, reserve requirements, discount rate, etc., to influence the availability and cost of money in the market. The central bank usually sets a target for the overnight rate, which is the interest rate at which banks lend to each other on a short-term basis. The overnight rate affects other interest rates in the economy. Interest rates are important because they affect various aspects of economic activity and well-being. Interest rates affect how much people save and invest, how much businesses borrow and produce, how much governments spend and borrow, how much consumers spend and borrow, etc. Interest rates also affect the exchange rate and the balance of payments between countries. To summarize, interest rates are the percentage of the principal amount that a lender charges a borrower for the use of money. Interest rates vary depending on various factors such as type, term and risk of loan or deposit, supply and demand for money, and monetary policy. Interest rates are important because they affect various aspects of economic activity and well-being. Thank you for watching this video on interest rates. I hope you learned something new and useful. If you have any questions or comments, please leave them below. See you next time.